to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, are AI stocks overvalued? It's the question investors have been asking, and we'll dig in for today's investor playbook. Plus, Warner Brothers Discovery missing earnings estimates as the company plans for a split. Full coverage on the entertainment industry ahead. And the Supreme Court hears arguments on President Trump's sweeping global tariffs. We'll discuss with Joe Lavorgna, counselor to U.S. Treasury Secretary Scott Bessent. Let's start with the major averages here and take a look at where we stand. We had started the day a little bit higher. Now things have gone lower. Right now the Dow is off by nearly 300 points, about 0.6%. The S&P 500 down by about the same amount, but it is the tech-heavy NASDAQ that is leading the selling at this point in the session. A lot of earnings news to follow here, but also we are seeing, as we see selling in stocks, we see a little bit of buying in the Treasury market, which is interesting here, pushing those yields back lower. And taking a look at the NASDAQ 100 specifically, you see a lot of red on the screen here. Really, the breadth is pretty negative here within the NASDAQ, and a lot of large cap tech is selling off. Specifically, we've been watching shares of Qualcomm, which are trading lower after that company's earnings down by 1.8%, although AMD standing out to me as well. Those shares down about 5% on the session here, so we continue to watch that. Just equal weighting this for 1 minute here to take a look at what we do see rising. Datadog, after its numbers, is higher, but otherwise it's pretty few and far between. DoorDash is falling after that company's earnings as well. And then if you look at sectors within the S&P 500, energy shares actually higher today, even after ConocoPhillips came out with what was initially seen as sort of a mixed report. But XLK, tech and consumer discretionary are the two biggest drags that we are watching in today's session. Getting back over to the semiconductors more specifically here, again, AMD trading lower along with most of the semi-complex. And more broadly here, it has been a pattern that we've seen throughout this earnings season. Tech companies beating estimates, even raising their forecasts, and the stock falls. We're seeing it again this morning with Qualcomm. So let's dig into what that reflects about the AI trade and where investors should be positioned right now. Joining me, Ivana Delevska, Sphere Invest founder and CIO, and Sylvia Jablonski, Defiance ETFs CEO and CIO. Ivana, I want to start with you on this Qualcomm example specifically because, again, we've been seeing this playbook sort of throughout earnings season. Here, it looked like Qualcomm had a pretty good quarter and the stock is falling. So what gives here? What's your perspective?
So Sylvia, what we've seen this earnings season is that it's all about positioning. So it's really not so much about what the companies are reporting, but more about how investors were positioned going in. Specifically to Qualcomm, they announced a new data center chip a few weeks ago, so the stock was up on that going into the earnings. They didn't quite provide any additional detail on the earnings. They said that more details will be coming next year, and this is why you're not seeing an outsized positive reaction to the beat.
Sylvia, what do you think sort of more broadly here? Because it's not unusual to see this. We've seen it throughout earnings season where the numbers initially look okay, but then the stock's been falling. Does this just reflect this sort of underlying wariness about the valuation question?
Hi, Julie. I think it's a great question, and it's really a great point, right? Because earnings seasons have arguably been coming in, fantastically. Even the companies that perhaps didn't, meet analyst expectations have done quite well. We're having 80% beats on the top and the bottom line. My take on this is that expectations are so high. There's a lot of talk about overvaluation, and essentially any little, deviation from the perfect report, I think is at this point going to set investors to perhaps take some gains in their positions or reduce because they're worried about this overvaluation problem and where we are. But what I would say is, when the market's rallying and these stocks are at all-time highs, which has been, every other day over the last couple of weeks, right? We hear a lot of investors saying, I have a lot of FOMO because I couldn't get in, right? And so here are the dips. And if you think AI is going to stick around and you think these companies like Qualcomm, Broadcom, Supermicro Computers, AMD, NVIDIA are going to be part of AI and the build out in AI infrastructure, it's worth considering looking at these names now.
What do you think, Ivana? Do you think the sort of buying the dip approach is the way to go when you see these kinds of sell-offs?
Absolutely, Julie. And to Sylvia's point, I think we do see people overbuying the stocks, but if you look at the valuations, they're not necessarily high, and this is because we're seeing the beats. So, right, each time a company beats expectations, the multiple, if the stock doesn't positively react, the multiple goes down. So this is why the dips are really good buying opportunities, because you're not really chasing a higher multiple.
I mean, to some extent then, Ivana, I'll put this one to you first. To some extent then, do the actual details of the earnings become less important in a way? If you're buying into this whole AI thesis, and you think that a broad swath of companies is going to benefit, like how much does the quarter by quarter matter?
So quarter by quarter doesn't necessarily matter, and the earnings reactions don't matter, but the numbers are very important in the long term, right? Or even on a few quarter basis. So if the companies are not consistently beating, it's going to be almost impossible for the stocks to keep going up, right? So you really need the numbers. Now, whether they beat expectations by more or less than the buy side expected, that's going to determine the quarter reaction. But whether they're going to be up into next year, it's really going to depend on how much did they beat by on several quarter basis.
Well, I want to bring up another example here with you, Sylvia, and that's Supermicro, which you mentioned. The company reported earlier this week the stock did fall, and there, it's not just about beat or miss, right? It's about, do you see that long-term path for growth? What did these Supermicro numbers tell us, especially given the fact that they recently sort of warned, and are there any concerns there?
Well, and to piggyback off of what Ivana said, I think it's a great point to make, right? The numbers do matter because we need to justify these multiples in order to get people to want to buy them. And I think, and then, dips in that case are good if the news is good. So with Supermicro, they came out and said that there were some design issues here. If you look at the overall global sales for the semiconductor industry, it's about a quarter-over-quarter growth of 15.8%. And, this company was kind of down 15% quarter-over-quarter on their side. So I think investors, though, because it has fallen quite a bit, this is a stock that has been a performer over the last few years, and they are a pure AI play. They are a company that's arguably, going to have some leadership opportunities in data centers and edge computing and 5G, in the general AI build out. And so I think that they're kind of in the right spot, right? So it just depends on what happens now with these designed and customizable chips, what kind of opportunities they get. But historically, it has worked with this stock to buy on the dip. That being said, again, to Ivana's point, the numbers do matter, right? So with the other companies that are falling, the numbers are there. So with this, we're going to have to wait and see.
And something else that is sort of out there in the ether, another story that was reported today, has to do with M&A. And so I'm curious to ask both of your perspective on this. It's the story that Bloomberg is reporting that SoftBank had looked at Marvell technology, possibly to buy it and combine it with ARM. And Ivana, I know that Marvell's one in your portfolio. So what do you make of that story? And do you expect more consolidation to happen?
Well, Marvell has been specifically very undervalued here because they did not out-deliver on the 2 prior quarters that they reported. And with expectations being high for the AI trade, the stock has really not performed well this year, especially compared to peers. So I think it makes total sense that SoftBank would be looking at buying it here. I think long term, it's a very strong story. They're levered to Amazon. And Amazon also themselves struggled a little bit to get Trainium up and running. Now it seems like it's doing much better. So I think the fundamentals for the rest of the companies that are exposed to Amazon are getting much stronger into 26. So the fundamentals for Marvell are pretty solid.
Interesting. Okay, so whether it's a deal, whether it's things inflecting a little bit better for Amazon, Sylvia, kind of what's the next catalyst now for growth? I mean, we've got NVIDIA coming up on November 19th reporting its numbers. I guess you could debate whether that's going to be a positive or negative catalyst given some of the reactions we've been seeing. But is that the next thing you're looking to? What's sort of the next thing now?
I mean, in terms of, we need the quarterly earnings calls. We need to hear what they're doing. We need to hear, particularly from Jensen Huang, because he is essentially the poster child for AI, or the stock is at least. Very much the bellwether and the market driver really this year. So it does matter. But that being said, I'm looking at, AI. The AI trade has worked incredibly well for investors in most semiconductor positions. I'm just trying to think about where is the puck going. And I think that now we're starting to have to look at the second and third derivatives of AI to really find these, kind of hyper growth opportunities potentially that can exist. And I think that looking at AI infrastructure, the energy, the AI powered infrastructure play behind just the chips and the whole, movement, it will be an interesting place for investors. Like you just look at these energy companies, you mentioned it at the start of the segment, they're doing quite well. And I think a lot of that is because they are powering this phenomenon here. So I'll be looking at AI powered infrastructure.
And what about you, Ivana?
I think that's spot on. Basically, we are ahead of the next wave of investments in AI, and it's specifically targeting the infrastructure side, so both physical infrastructure and software infrastructure. So I think there is a lot of opportunities on the networking side and a lot of opportunities on the power generation side.
All right, ladies, thank you both for being here. Appreciate it, Ivana. Sylvia?
Thanks, Julie.
Thanks. And be sure to tune in at 3:15 p.m. Eastern today for an interview with Qualcomm President and CEO Cristiano Amon following the company's earnings. You don't want to miss that. Coming up next, we got all your markets action. We'll be digging into earnings from Warner Brothers Discovery. Stay tuned. Warner Brothers Discovery swinging to a third quarter loss, including a 6% decline in revenue, but the company confirmed plans are still on track to split into two companies by mid next year. Joining me now, senior reporter Ali Knal and Geetha Raghunathan, Bloomberg Intelligence senior media analyst. Ali, let's start with you. Just give us those sort of highlights of what we need to know from this report.
Yeah, from the report and also the call, which just wrapped up about an hour ago, as you said, Julie, is still on track for that mid-2026 split. It seems like a split is plan A, but they also said that they are open to all strategic alternatives, which include a potential sale of the full company or parts of the business. Now, they would not talk specifically about the different bidders that have been in the media, in the news. We know from various reports that that includes Netflix, it includes Paramount, and also Comcast. Now, Netflix is likely only interested in the studio side of the business, having control of that IP. They said on their own earnings call that they have no interest in owning any type of linear networks, whereas Paramount Global has reportedly been interested in acquiring the entire company. Again, they didn't really say either way, but it's clear that the breakup plans are starting to gain a bit of urgency. And this earnings report really highlighted the need for that. We saw the bright spot came from the big screen. Films like Superman, The Conjuring helped push movie revenue up 74%. But that success wasn't enough to offset losses on the TV side of the business. We saw network revenue drop 23%, advertising down double digits. Like you said, the overall company swung to a $148 million loss on just $9 billion in revenue compared to a profit just 1 year ago. So there's just this wide gap between WBD's studio business and then the struggling linear side. And then finally, another thing that stuck out to me on the call is that Warner Brothers Discovery is really trying to set up the sports side of the business and news for the next chapter. So they were saying that they plan to build a new standalone U.S. sports streaming app, and they're also retooling CNN into a global digital subscription platform that they hope can stand on its own. So really trying to modernize different parts of the business. That is their pitch to all the potential bidders. We'll see. There is reporting that they will announce by Christmas whether or not they're going to sell all the business, whether or not they're going to commit to that split. But like I said, that the split is plan A, set to be completed in mid-2026.
And Geetha, let's get to you here. So what did we learn in this report that tells us about the value of each of those parts in a potential split?
Yeah, absolutely, Julie. Ali's absolutely right. The studio and streaming businesses are progressing really, really well. And this is really where the value for Warner Brothers Discovery is. So as they kind of split, the two units into the no growth, which is the TV networks, which is plagued by, constant cord cutting, ratings weakness. That is obviously a part of the business that is generating a lot of EBITDA. We're looking at about $6-7 billion in EBITDA. But unfortunately, the multiple that you're going to be able to achieve on that business is going to be at most mid-single digits. A turn to the other part of the business, which is really the high growth story, the studio and the streaming assets, which everybody seems to want, including Netflix and Comcast. And that, is generating this year will generate close to almost $4 billion in EBITDA, has a really strong path to, get to far more higher levels of profitability. But the valuation multiple that you're going to be slapping on that business is going to be something like mid-teens. So obviously it speaks to very different growth profiles of these two businesses. And really what we're looking for in terms of a combination is the synergies. So, if you're looking at even a Comcast kind of coming in, just kind of combining the studio unit with all of NBC, we're looking at something like $3, $4, $5 billion in synergies or cost savings. And that is really where a lot of the value is going to come from for any of these bidders.
To that, Geetha, you were just talking about some of the synergies. I guess out of all the potential bidders, who do you think would benefit most from that access to WBD, whether it be the entire company or just that studio IP?
So I think in terms of the entire company, Ali, I think Paramount obviously benefits the most. They are the ones who seem to really lack a clear strategy at this point. Yes, Paramount combined with Skydance, I just don't think that's going to be enough to move the needle. They are in a pretty bad spot when it comes to both their TV networks business as well as the studio and the streaming business. The streaming business still doesn't make any profits. Yes, they've kind of gone out, acquired a lot of sports rights, whether it's the UFC. They've done these content deals for, South Park, Duffer Brothers, but they've also lost Taylor Sheridan. So, there's a lot of different moving parts here. In terms of, the most upside, I think Paramount Skydance has to benefit the most, especially if they buy the entire company. In terms of the least upside, I would say it would be Netflix. They really don't need to go out and acquire the studio. I really see this more as a defensive move for them. I don't see them being able to dramatically increase their subscriber base, which, by the way, right now is well over 300 million just by bringing on HBO Max subscribers. So they'll have to kind of pretty much, shutter down the HBO Max business. They pretty much have to shutter down global theatrical distribution. Yes, they do get a lot of IP. They do get a fantastic library. I just don't know whether it's going to be worth it because we're looking at a price tag that is somewhere in the range of about 75 to 80 billion. And I just don't know if Netflix should pay such a high price.
And Geetha, just quickly, lastly, if you're talking about the non-film business at Warner Brothers Discovery, like if it is so tepid, why does anybody want it? What could be the fate of that if it does end up getting split or not getting taken over by Paramount?
No, that is a great question. The reason, it still throws out a lot of cash, Julie. So, we talk about the business. Yes, we talk about, the TV business being severely challenged. It is kind of a melting ice cube. But the idea here is that if you combine forces, you can stem that decline. And there's still a lot of value to be extracted because, as I said, again, throws out a lot of cash. So even this year, of the total EBITDA that Warner Brothers Discovery will generate, 70% is going to come from that challenged asset, which is the TV networks. So there's still, a lot more to go. Of course, there's no growth, but there is value in a combination in a potential M&A transaction.
Gotcha. Thank you so much, Geetha. Good to see you. Thank you, Ali. Appreciate it. Well, we just heard the investment storyline behind Warner Brothers Discovery's earnings report. How about the impact of the company's planned breakup from the perspective of someone who actually produces movies and TV shows? I'm joined by Chris Fenton. He's a media executive and professor at the University of Southern California. Chris, thank you for being here. So we've been talking about, what's going to happen with Warner Brothers Discovery. Will it break up? Will Paramount Skydance take it over? As somebody who sits inside the industry, all of this, what does it sort of reflect about the backdrop for the business of making entertainment right now?
No, it's a great question. It was fantastic to listen to those analysts talk about it from the financial perspective. But the fact is, there's also a huge creative and human perspective involved with this. Just in the last few years, we've lost 41,000 jobs here in LA County in the entertainment business. Obviously, further consolidation will further mitigate the amount of jobs that are here. And then on top of it, we're looking at a consolidation in the creative aspect of Hollywood. Even if Paramount takes over Warner Brothers, you're probably going to see a downsizing in the amount of output that is put onto the screens as far as the movie business is concerned. And if a Netflix picks up a Warner Brothers, they might actually just more pick through the library and do redos of a lot of the IP that they would acquire in such a situation. So we're seeing a lot of nervousness and a lot of people really on pins and needles in terms of how this is going to play out over the next few months.
And Chris, we were looking sort of, obviously, the movie business is huge out there on the West Coast. We were also looking at Atlanta, which had been such a growth area for the filmed entertainment business over the past few years. But we've now been seeing the number of things being shot there really decline as well. It's been happening in LA, to your point. What's been contributing to that besides this consolidation that you're talking about?
Yeah, well, what's really contributing to it is the fact that we don't have a national policy in terms of film rebates and subsidies. So it's really hard for the United States to compete on a production cost level with the 70 plus nations around the world that do have nationwide subsidies and rebates. So there are certain markets around the world where you can actually get as much as 50% of your production costs back by the end of production. Here we have states with very aggressive incentives and rebates, but they simply can't compete with that. And then when you look at countries, say, such as Canada, with a currency that's much weaker than the United States, you can actually see even a more amplified effect. So when you look at Georgia, for instance, we've lost 50% of the production that was done there since 2022. That's about $2 billion worth of direct economic activity. And Marvel was a big part of that. And on every Marvel movie, there's anywhere from 3,300 to 4,500 people that work on those crews. That's a lot of jobs.
Yeah, it is a lot of jobs. As you know, President Trump in the past has floated an idea of tariffing films that come into the U.S., although it hasn't happened. I'm not sure how it would work from just a mechanics perspective, but it sounds like you think that incentives would be much more effective than something like tariffs.
Well, look, what we're trying to do is incentivize the studios to keep production here, which is just one industry in order to bring back manufacturing, right? We're trying to do that in the automotive space and technology and various other areas of industry. Hollywood's just another one of those. So what we're trying to do is get the studios to say, hey, look, it's smart for us to keep production here. How do we do that? Well, there's both a way to do it through rewards and also through punishment, just like raising a teenager, right? That mix is going to make it a way that studios will evaluate and decide to keep it here. Personally, I'd rather keep it on the reward side. More incentives, more subsidies, and a way to make it easier and more cost effective to shoot here in the United States. I'd like to avoid the punishment side, which is really the tariff scenario.
Chris, also at the center of the trade war is, of course, between U.S. and China. Films have been sort of part of that. And you have a lot of experience about U.S.-China, the film business between the U.S. and China. So what's the sort of current state of play, and what effect is that then in turn having on the U.S. movie business and the Chinese market?
Well, the Chinese market was a golden goose for a long time for the United States. It was a major part of the revenues that we were generating on an annual basis. But unfortunately, we really taught them well how to manufacture their own product there that caters to their audience way better than anything coming from Hollywood. So at certain points in the last 10 years, we were as much as 60 to 70% of that market. Now we've dropped down to 5%. So the China market has really become insignificant. But that doesn't mean the international market is. We're still generating on big franchise movies as much as 60 cents on every dollar that comes in. So it's important for us to look to the consumer around the world and try to create content that will engage them.
Chris, really appreciate your perspective. Thank you so much.
Thank you for having me.
Coming up, we'll bring you today's top calls on Wall Street and the trending tickers you need to know. That's next.
Welcome back to Yahoo Finance. I'm Brooke Tabama, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Robinhood, Elf Beauty, and Lyft. First up, Robinhood shares are falling this morning after its cryptocurrency revenue missed the street's estimates, and its CFO shared plans to depart in Q1 of 2026, yet Wall Street remains bullish on the stock. Mizzou analyst Dan Dolev raised his price target to 172, up from 145, and there are 20 buy ratings, 8 holds, and 1 sell on the street. Next up, we're taking a look at e.l.f. Beauty. That stock also taking this morning after it forecasted weaker than expected fiscal year 2026 guidance. And that led Bank of America to cut its price target on the stock to $130 per share, down from $160. Keep in mind, though, the average 12-month price target on the street is currently $122. Last up, we're taking a look at shares of Lyft because the ride-sharing app forecasted a better than expected acceleration in bookings for the fourth quarter as it really focuses on healthcare and adult rides. That led multiple firms to raise their price target on the stock, including Barclays to $27 per share, Benchmark to $30, and Cantor Fitzgerald to $25. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout today's trading session.
Now time for some of today's top trending tickers. We're watching Penn Entertainment, Metsera, and Boeing. First up, Penn Entertainment. Disney calling it quits with the company as its sports betting partner. Disney said it was terminating its agreement with Penn Entertainment years earlier than planned. It's now chosen DraftKings as its official partner. ESPN inked its previous deal with Penn in 2023. And Disney had made clear in the past it would never take bets directly, making a partnership the only viable path for ESPN to get into the online sports gambling industry. We see Penn down about 4%, DraftKings gaining about 2%. Next up, Metsera. Shares jumping after a judge denied Pfizer's request to block Novo Nordisk's bid for the company. Novo Nordisk has boosted its offer for the obesity startup to $10 billion. According to the Financial Times, Pfizer has matched Novo's offer for the company. Novo said it agreed with the court's decision and that its bid is in the best interest of Metsera shareholders. Pfizer said the court's decision fails to address the legal issues that the company had raised. And finally, Boeing avoiding a criminal charge over 2 fatal 737 MAX crashes after a federal judge paved the way for a $1.1 billion settlement agreement. The judge granted a request from the Justice Department to dismiss its criminal case against Boeing. The deal requires the plane maker to pay fines and to compensate family members of crash victims. The decision marks a milestone in Boeing's effort to move on from those fatal crashes that the company's finances and reputation has been a headwind or overhang to. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the Supreme Court heard arguments about the legality of some of President Trump's tariffs. Treasury Secretary Scott Bessent saying Wednesday he is optimistic about the hearing, thinking the court will side with the administration. But if struck down, the government could have to repay some of the nearly $200 billion in tariff revenue already collected by the U.S. government. For more, I'm going to send it over to our Washington correspondent, Jennifer Schonberger, who's with Joseph Lavorgna, U.S. Treasury Department counselor. Jennifer?
Thanks so much, Julie. Joe, thanks so much for joining me. It's great to see you.
Thank you, Jennifer. Same here.
In oral arguments yesterday about whether the president has legal authorities to issue tariffs under emergency economic powers, the Supreme Court justices seemed to express some skepticism about the administration's arguments, even some of the most conservative justices on the bench. What was your reaction to those arguments? Are the tariffs in danger?
Well, I mean, certainly the court asked a lot of questions, and the president has worked incredibly hard to address what clearly is an emergency situation with our trading partners as it relates to historically large deficits and also issues as it relates to national security. And the administration, as Secretary Bessent said yesterday, does believe that we've made a very powerful, compelling case. We do believe the court will rule in our favor, that the president has the ability to decide what an emergency is. As it relates to foreign policy, the historical record is clear. The president has that bandwidth. It is a signature legislation, so to speak, or one of his signature policy initiatives, along with the One Big Beautiful Bill. And historically, the Supreme Court acknowledges those sorts of things and does tend to agree with the administration on these issues. But again, we do believe the president has the authority, and we're hopeful that it will be resolved in a satisfactory way.
I know you just said, Joe, that you think the court will rule in the administration's favor. The president has called this case literally a, quote, life or death decision for our country. And certainly the tariffs have been the economic centerpiece of the president's economic agenda. What is at stake here if the high court were to knock this down?
The president said it the best. This is really would be an historic ruling if it was to go against the U.S. These tariffs. Look, Jennifer, the The IEPA, the International Economic Emergency Powers Act, gives the president the authority to regulate imports. That means if he wanted, he could put an embargo on against a particular country to have none of those goods come in. A tariff effectively works the same way, but works in a more nuanced, more effective, more surgical way. And this policy, if it's reversed, is going to undo what the president wants to do in fixing the emergency, getting trade deficits down, being able to have more national security, which is interwoven with economic security in the U.S. And the IEPA is a key tool to do that. We won't be able to reindustrialize. We've got capital coming in. It's coming in because of the tariffs. We've got the One Big Beautiful Bill, which kept the Trump 2017 tariffs, taxes in place and tax policy in place. We've got cheap and abundant energy, business deregulation. So as you said, the tariffs are a centerpiece. The president's exactly correct. If the court mistakenly were to rule against us, that would cause unnecessary economic pain and hardship. We're hopeful it won't happen, and we'll see what happens.
Just to dig a little bit deeper on what you just said there, what type of economic pain could we see? I mean, yesterday I spoke with Federal Reserve Governor Stephen Miron, who said at the very least it would increase uncertainty and drag on economic growth. What supply chains, to your point, are being resituated as a result of these new lines that are being drawn by tariffs? We've collected nearly $200 billion in tariff revenue as of September 30th. If you could expound on what kind of economic ripples we could see as far as recession or not, please do.
Yeah, well, Governor Myron made some very good points. I completely agree with him on that. But even Justice Barrett talked about, well, how would you even give the money back? How would you give the refunds back? It's a very complex issue. There were some third-party providers that were responsible for collecting the tariffs. How would it work? How would you disperse those funds? Financial markets, which initially were nervous about these tariffs, they were nervous about President Trump's policies, have cheered those policies. Yes, so to the extent that the policy would be reversed or watered down, that would damage financial markets. It would damage confidence. The system, the economic system, capitalism works on confidence. You've seen record high equity markets. You've seen record low credit spreads. You've seen commitments by all different countries and companies to invest in the U.S. Everything works hand in hand with what President Trump's vision is to reindustrialize and rejuvenate the U.S. economy and build things again. So I'm an optimist. I don't want to think about, the worst case scenarios. The president has been very clear in what he says and what he believes, and we're totally on board with that. Keeping our fingers crossed and figuring that, common sense here will prevail.
Fingers crossed, common sense prevails. But in the worst case scenario, does the administration have a contingency plan in place? For instance, could we see more tariffs enacted for different sectors under Section 232?
There are various, as you know, there's 232, there's 122, there's 301. There's a variety of different sections. The Treasury Secretary yesterday mentioned he didn't want to go into the details, but he is well aware and very well prepared in the unlikely event that the case was not to go the way we wanted, that these tariffs would be put in through other avenues so as to accomplish the administration's goal, which has been incredibly popular, obviously, with financial markets, investors, American people, because, again, you're going to reindustrialize. You're employing Americans to build the factories with the foreign capital that's coming in. They're going to be employed by Americans, but there will be contingency plans put in place at some point should the court rule improperly.
Switching gears, Joe, the government shutdown is now officially the longest on record, day 37 today. Any sense of how much longer this could stretch on? And what are we dealing with as far as the economic impact so far? If this continues on much longer, what does the economic impact look to you then?
Well, the president, with Secretary Bessent's help, we've been able to pay the military. That's not going to continue. There's another payment, I believe, coming on the 15th. SNAP benefits, which people need. The Democrats are preventing us from fully giving those benefits out to folks. There's been some chatter in the news this past week, some comments that I think Leader Thune had mentioned that makes me optimistic. Maybe we can get something solved soon that some of the Democrats, some of the centrists, there are a few, will come over to our side. I mean, we don't have the 60 votes necessary to reopen the government. And that's a problem when the Democrats, who historically would support these clean continuing resolutions, it happened numerous times over numerous administrations with Republicans when they were the minority party, 15 times to be exact over the prior 4 Democratic administrations. This is the worst sort of politics. It, like I mentioned with the Supreme Court ruling, adds another layer of uncertainty. It causes businesses at the margin, Jennifer, to step back, to not commit capital. That means then less hiring, less output, less growth. CAA said we could be losing upwards of $15 billion a week. That could translate into half a point on GDP over an extended period of time, and even more if this shutdown, God forbid, were to go through the month of November when people are trying to travel and visit their families. Secretary Bessent perhaps said it best. We just need a handful of Democrats to do the right thing, be national heroes, and vote with us to reopen the government. Then we can have the discussion on some of these other things that Democrats want. But this is not the venue to close the economy down, not have hardworking men and women in our armed forces and elsewhere not get paid because of a desire to demand a vote. It's very juvenile on the Democrats' part.
And before I let you go, Joe, Secretary Bessent said over the weekend that he feels that there's a chance that parts of the economy, particularly housing, may be in recession already because of high interest rates. Is Treasury looking at taking any action, whether it comes to bill issuance or otherwise, to bring down yields and thus push down mortgage rates?
The Treasury increased bill issuance because it had to rebuild its Treasury balance, and the bill issuance now at around 20-ish% of total issuance is about in line with the historical average. I think what Secretary Bessent has made a very compelling case, and certainly this is something the president is certainly 100% in agreement with, is that his interest rates are too high. They're too high by the Fed's own admission. R star, or the neutral rate, is well below, even now, despite Fed cuts, where the current Fed funds rate is. I'm hopeful at some point that the Fed will lower rates further and realize that the tariffs, which are going to be incredibly successful in rebalancing and dealing with the current emergencies that we have, are not inflationary. They've not led to an increase in inflation expectations. The Fed should cut rates, and that in the short term will certainly help housing. And as the Secretary said, there are some sectors that are weak, and housing is one of them, and interest rates are basically the most dominant variable there.
All right, Joe. Well, so many more questions, but we'll have to leave the conversation there. Thank you so much, as always, for your insight.
Thank you,
so
Jennifer.
Appreciate it. Hope to see you soon.
Great to see you. Thank you.
Counselor to the Treasury Secretary Bessent. Julie, I'll send it back to you in New York.
Thanks, Jen, and thanks to Joe as well. Well, we're nearing a big day here at Yahoo Finance, our annual Invest event. It's on November 13th, starting at 8 a.m. Eastern. We've got a special full day of live global coverage of the key themes driving the market, including AI, crypto, and more. We'll be talking about the future of pharma with Pfizer CEO Albert Bourla. Eric Trump will be stopping by to explain his all-in stance on crypto. And former Fed official Lael Brainard will share her latest thinking on the outlook for interest rates. Don't miss it. Yahoo Finance Invest live all day on November 13th.
You continue to see, modest potential overall job creation. You continue to see moderation in wages, and you continue to see indications that labor demand may not be as strong as we'd like it to be from a cyclical perspective. All of that, to me, is an indication that that rates could be a little bit lower than where they are now.
How much of this that's driving the job market right now is structural versus cyclical? We know there have been major policy changes that have come from the administration, which take time to work through the economy. What's your sense of that? And do you have the tools, if it is structural, to deal with that?
Yeah, so a lot of the changes to the number of job creation, to the levels of job creation that would occur as a result of policy changes like immigration are what we as economists would call output gap neutral, right? Economically, the role of monetary policy is to balance supply and demand in the economy and to make sure that you don't have demand so far outstripping supply that you get, upward spikes in inflation, or that demand isn't cratering relative to supply so that you get downward spikes of deflation of the type that you have in a depression-like environment. And so the goal of monetary policy is really to balance supply and demand. Now, if you have changes in, let's say, population growth because you either have a policy of large-scale mass immigration or you have a policy of closed borders and net zero migration, that's going to be what we would think of as typically, in my opinion, output gap neutral. And the reason that's the case is that when you have an additional person in the economy, they're generally consuming as well. They're working and they're consuming. And so from an output gap perspective, it's not clear that there's a very big role for monetary policy to play, because it's not the case that supply or demand are moving by very different amounts. They could be moving by very similar amounts. And so some of the low levels of growth are a result of changing border policy. If you have an economy in which you're throwing in large numbers of new migrants, of course, the overall job number will be flattered by that. And if you stop that, the overall job number will reflect stopping that. But that's not necessarily something that monetary policy responds to automatically.
And sort of building on that, the president has gotten many companies to invest billions of dollars in this country. We're going to be seeing investments in technology, in AI, in factories at the same time. The tax bill has been made law. We've got 100% expensing on PP&E and factories. How much job growth could we see from that? And what is the timeline on that? Is that a 2026 story? And again, kind of going back to those longer term structural versus cyclical trends, how are you viewing that as it relates to the labor market and setting policy?
Yeah, so look, I do believe that the supply side of the economy matters, right? I'm not, I don't exclusively look at either just the supply side or the demand side. I think that they both matter. And as I said a moment ago, the role of monetary policy is to balance them. And I think that there's a whole slate of expansionary policies on the supply side that drive out the productive capacity of the economy. You mentioned some of them, things like the full expensing provisions from the tax bill that was passed over the summer. There's now a huge tax incentive to invest in new factory equipment or to invest in factory structures. I do expect that to result in some additional investment demand. That additional investment demand pushes demand up higher in the short run, and a little bit longer run, it pushes the supply side of the economy out because you can produce more because you have more capital. And that's all stuff that matters when you think about the outlook and when you think about where monetary policy should be. But there's other elements that are pushing out the supply side too, and think about regulations. Regulations really shape the structure of the economy because they decide whether you can produce or not and what you can produce or not. So the industries that you have in the country, how big the industries are and where they're located, can all be a function of the regulatory environment. And as you change those, you can change the supply side of the economy too. And pushing out the supply side of the economy in those ways, and sometimes it'll take demand with it. For instance, and the full expensing, right, will create investment demand. But in other things like regulations, it's not as clear to me that it pushes out the demand side as well, and it actually expands those output gaps that I mentioned a moment ago that monetary policy should respond to. So I think there's a variety of policies that are affecting the economy. They affect the short run, they affect the long run, they affect both of them, and they affect the supply side and the demand side. And it's really important to be thinking about the ways in which those are happening and trying to disentangle them and how monetary policy should respond to that. And we typically think about monetary policy as responding to three things. It responds to the output gap that we talked about. It responds to the outlook for inflation, which can also be affected by these policies, and it responds to changes in the so-called neutral rate. That's the level of monetary policy that's neither restrictive nor accommodative. And so you'd want to be looking at all of these policies and trying to say, okay, what's it doing to each of those three things?
Switching gears, the Supreme Court is hearing oral arguments this morning about whether President Trump had the authority to issue tariffs under emergency economic powers. Under those powers, we've seen many trade deals cemented. The U.S. has pulled in nearly $200 billion in tariff revenue as of September 30th, 2025. If the High Court were to rule that issuing tariffs under those authorities were illegal, and I fully recognize that the administration is working on contingency plans, but what would that mean for the impact on the economy? Would that increase uncertainty, pressuring growth and hiring?
Yeah, so absolutely, something that would affect uncertainty would something that would increase uncertainty over the tariff environment, over the trade environment, is absolutely something that could be a drag on the economy, and that might come as a result of the deliberations you referenced. That type of drag on the economy normally would, all else equal, depending on how the Fed is doing on hitting its two mandates of price stability and maximum employment, but all else equal, in addition of uncertainty from something like that, is something that you would think of us as normally offsetting with moderately looser interest rates. And there's been other sources introducing trade uncertainty in the recent past too. We recently just had another little trade confrontation with China that resolved favorably for the short run, but we'll have to see sort of the durability of something like that as well. But also, the revenues that the revenues that you mentioned matter because the amount of savings in the economy sort of ties back to monetary policy for thinking about where we set interest rates. And if you have an increase in national savings, it normally is the type of thing that would lead to lower interest rates, along lines that I discussed in a recent speech of mine that I gave a little bit over a month ago. And if that revenue were to go away, then you would sort of naturally think that would have implications for interest rates that would be of importance to monetary policy.
90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We are still seeing a downdraft in stocks today. It's particularly acute in the NASDAQ, which is now down about 1.6%, as we see a sell-off going on in large cap technology. But we're also seeing selling more broadly. The S&P 500 is off 1%, and the Dow is down about 375 points, or about 0.8%. And as the government shutdown stretches on, now in its 37th day, the Federal Aviation Administration says it will reduce flights across the country. It says to maintain safety. Here with more on what to expect as the shutdown continues, Yahoo Finance Washington correspondent Ben Worschel. So Ben, what do we know about these flight cuts? And this is different than even the past long shutdowns, correct? Because they didn't take measures like this.
Absolutely, yeah. This is definitely different. This is not only different from the last shutdown, it's different from what we've seen at the airport so far. So far, we've seen kind of scattered delays that have been growing each week, but not at the level of what could be in the offing in the coming days. What Transportation Secretary Sean Duffy has talked about here is 10% cuts in air traffic capacity across the country. This is 40 airports that would be affected here. This translates into thousands of canceled flights, possibly, depending on how this plays out. We don't have a formal list yet of which airports, but there's some preliminary ones floating around, and it's basically every airport you can think of. I looked at it, it was from Anchorage, Alaska, to LAX, to Atlanta, to all 4 airports in the New York area, if you count Teterboro as well. So this is essentially every airport, every major airport in the country, with a 10% reduction in flights that will sort of phase in over the next coming days. It starts on Friday with the first cuts, fully implemented next week. Duffy has said that these cuts could get even deeper if we're in a shutdown in about a week's time, as these air traffic controller shortages heighten. As a reminder, these controllers haven't been paid in over a month now, and the strain on the system is kind of reaching a breaking point from Duffy's perspective. This move, he says, is to alleviate the pressure and to kind of get ahead of any potential safety issues that could be in the offing.
So we just had an election. We're in the 37th day of this thing. We've got now the FAA shutdowns. Are we any closer to any kind of compromise that could end the shutdown?
Yeah, I think there's kind of bad news on that front, in that we seem to be, the mood here in Washington is essentially we are a little further from compromise today than we were a couple days ago. This week began with talk of off-ramps and bipartisan talks that were occurring potentially to kind of end the shutdown more quickly. As you mentioned, the election, that factor seems to have scrambled the calculus a little bit. This is an election that, as we all know, saw kind of widespread Democratic gains, and the response from both sides has been essentially to harden their position. President Trump's initial response, even as he admitted that the shutdown is bad politically for Republicans, his move in response is to try to end the Senate filibuster. That's a pretty unrealistic option, at least when you talk to Senate Republicans who are pretty firmly opposed to that option. So that side isn't on the same page at the moment. On the other side of the aisle, progressive Democrats have taken these results. The lesson they're taking here is we should continue to fight. They think voters appreciate the stand here, especially sort of elevating the healthcare issue, and they're less interested in compromise. You see that from figures like Bernie Sanders, Chris Murphy of Connecticut. In the middle, as always, are moderate Democratic senators who are still, I'm told, continuing to be in conversations, but they clearly have a more difficult task, at least this week, to reach some sort of short-term compromise when all that's really on the table at the moment is minimal concessions, if any, to Democrats.
Ben, thanks a lot. Appreciate it.
Good thing.
Let's keep talking about all of these D.C. issues. Of course, it's a busy week in Washington. We've got the Supreme Court hearing of some of President Trump's tariffs. We've got the government shutdown, now the longest in U.S. history, and we don't seem close to ending it anytime soon, as we just heard. For more, I want to bring in Terry Haynes, Pangea Policy founder. Terry, it's great to see you. I'm curious first to get your take on this question of what comes next with regard to the shutdown.
Good morning, Julie. I think it probably ends by Thanksgiving for precisely the reasons that you're mentioning. The kind of the practical pain that people will go through, whether it be air traffic, whether it be SNAP benefits, even the economic data or lack of it probably plays a role in all of that. But what you and Ben were just talking about is exactly tracks what I told markets on the election night, which was, Democrats are now going to have their backs up a little bit more, firstly. Secondly, my view of this all along, since before the shutdown started, is this has never been about substance. Democrats picked the healthcare issue as the hill to fight on about 2 weeks before the shutdown. It was never politically they needed to show fight to their progressive base and their progressive donors. So they are continuing to do that. The election results, frankly, embolden them to continue to do that. And finally, I'd note, kind of the body language. Democratic leader Jeffries in the House gave an interview last week in which he was asked two questions. One, Speaker Johnson's office is about 30 feet from you down the hall here, and why don't you just go talk to him? And there was no response. Second, have you ever picked up the phone and called the president and said, listen, let's try to work something out? And Jeffries didn't respond to that either. To me, that body language tells you all you need to know about whether there's actual interest there in ending anything anytime soon.
Well, as we know, the initial meeting between the president and Jeffries and Schumer, it was interesting, to say the least. Not very productive, also, to say the least. Terry, so if all of this is true, then how does the logjam break between now and Thanksgiving? I know you described sort of the pressure points, but how do you think it's going to play out, and what's going to force these parties to the table? Well,
Democrats have always left themselves an escape hatch. The escape hatch is that Republicans don't want to negotiate on the health care issue. Yet Republican leaders in the House continue to say that they will. The president took a good amount of airtime in his 60 Minutes interview on Sunday to say that he'd be happy to do that. The only precondition is that they've got to get the government reopened. So it's just a matter of when Democrats want to declare victory and move forward on that basis. What they're shutting the government down over right now isn't whether or not Republicans will negotiate. It's actually over a technicality about whether or not that is linked up with the government being open or closed. So, kind of any time they want to deal with that, they can do it. Meantime, they still continue to have a few defections in the Senate, and meantime, there's also increasing outside pressure from Democratic-leaning unions and others.
Right. I want to switch gears and ask you about one of the other big things going on in Washington, and that's the Supreme Court considering the legality of the IEEPA tariffs specifically. We've been watching the odds markets here, and the odds of success by the administration in this way are going lower. So which way do you think it's going to go? Let's start there, and then I'll ask you what's going to happen next.
You won't be surprised to hear me say I'm frequently a non-consensus person. I'm non-consensus on the tariffs. I think the Supreme Court's likelier to validate them, to keep them going, than invalidate them. 2 points. the questions presented before the court, and the court gets to decide what they are fairly narrow questions about whether the IEEPA statute specifically authorizes tariffs or not, and if so, whether or not Congress exceeded its constitutional authority and gave too much authority to the president to decide those things. Those are both important issues, but they're not the only issues in the case. Fundamentally, the question has to do with whether and the court apparently doesn't disagree with that. Otherwise they would have taken argument on it. Really two things. One is that the court always recognizes that the president constitutionally has the broadest and the widest discretion to deal with international emergencies. There's even a test for this, which was devised by Justice Robert Jackson in a 1952 case. Secondly, the court will not want to contribute to disrupting the administration's response to an existing international economic emergency. And thirdly, I just say parenthetically that in my day anyway, every first-year law student was taught that the court members typically will ask penetrating questions, but the penetrating questions tend to, in a lot of cases, tend to be counterfactuals and the like, and aren't, can't be taken literally to assume the direction of how the court's going to respond. So I got a situation here where they're going to be looking for ways to help the president here rather than hurt him.
We shall see, Terry. We'll catch up again. Thank you so much.
Thanks, Julie.
We're going to sit down with the CEO of Charles Schwab as that firm makes a $600 million push into private markets. That's next.
All right, Charles Schwab is pushing into private markets. The asset manager agreed to buy Forge Global, a marketplace for buying and selling shares of private companies. Joining us now is Charles Schwab CEO Rick Wurster. Rick, good to see you. Your first big deal as CEO since officially taking over earlier this year. Congrats to you and your team. So why'd you pull the trigger on this one?
Well, it's a great way for our clients to be able to participate in the growth of private markets. Private markets have long been something that have been available to the high net worth and ultra high net worth, and there's been a lot of wealth created there. But they haven't been available to the everyday investor. And by buying Forge, we open up that opportunity to all of our clients, both the RIAs, the RIA market, our retail clients, and it'll also help our workplace business. So we're thrilled about the opportunity to democratize access to private markets and to give our clients another opportunity for diversification and wealth creation.
Well, all acquisitions, Rick, of course, have to be integrated. How do you integrate something like this, a business that's focused on private markets with some of the business that you already have?
We want to integrate it right into our experience. The big opportunity for us with this acquisition is to take the capabilities and the skills that Forge has built up over the last 11 years and make them available to our 46 million clients. And so we're gonna lift and shift their capabilities right onto the Schwab experience, and our retail clients and RIAs will have the opportunity to participate in private markets. And we're really excited about that. And with this acquisition, we'll have 3 ways clients can participate in private markets. We've built both a retail and advisor platform for accessing the world's leading alternative managers, and that will continue. Through this acquisition and the fact that Forge has an asset management arm, we'll be able to roll out a 40 Act fund where investors will be able to invest in the biggest 60 private companies in our country in a single diversified 40 Act fund. And that is going to be really compelling, I think, to a lot of investors. And then third, for those clients that want to participate in an individual name that they're aware of, that they know that they have interest in, they will be able to do that as well. So we'll have a opportunity for investors to invest in a lot of different ways in private markets, and we're just thrilled about it.
This, this certainly changes the future of investing, Rick, but it also puts pressure on some of these private companies to disclose more about their businesses, though, right?
Well, one of the things that appealed to us about Forge is they have the most robust research platform in the industry. The reason we're bringing Forge or bringing Forge out to our clients is because we want to enhance the wealth growth of our clients. And in order to do that, we want to make sure that they have all the information they can have to make the best decision about whether to participate or not. And so that research capability, which provides a lot of information on the private companies, was a critical part of us being interested in Forge.
It really is an amazing time to be a a private company. You know, I've tracked the Yahoo Finance private markets data powered by Forge, and the valuations have gone through the roof over the past year, in large part because of top 10 companies, of course, AI related. But what is your sense of some of these valuations on private companies at this point in the economic cycle?
It's hard to make a valuation call on over the short term. What I do think is true is that over the long term, private companies have created tremendous value and has been a great way for investors to generate wealth. And this provides the opportunity for our RIA clients and our retail clients to get invested in that dynamic. It's hard to say whether in the short term there may be a pullback in markets, both public and private, or whether they'll continue the strong appreciation that we've seen. But I'm confident that over the long run, investing in private companies will be an attractive way and a diversified way to generate wealth for our clients.
You're, of course, at your Schwab Impact event. I know it's always an important one for you. It's in Denver. What's your sense of what's the mood amongst advisors on the ground there?
Mood amongst advisors is at an all-time high because I think our industry is growing so well, and it's growing so well because of the fiduciary model. The independent advisors that we have here at our Impact Conference all stand behind the best interest of clients and bring everything they can as a fiduciary to making sure they live their best financial life. And our 16,000 advisors on our platform are helping clients navigate difficult decisions every day about their wealth, including how to manage the tax consequences of what have become very large concentrated positions for many clients, how to create the right charitable donation strategy, and how to pass along wealth in the most effective way. So our advisors are making a huge difference in the lives of clients across our country and communities all over the United States. And we're thrilled to have them here, and it's nothing but enthusiasm for the role they're playing in markets.
Rick, lastly, you just piqued my interest. You know, it has been a big year for markets. A lot of investors sitting on record gains. How are investors and advisors thinking about tax implications after a big year for markets?
I think because the S&P is at an all-time high in terms of the concentration of the index, we do see a record number of clients that have concentrated positions. And so what we're able to do is bring the capabilities and skills of Schwab, as are the advisors, to their clients to help them think through strategies for creating diversification from a concentrated position without having to pay a lot of taxes. And there's many strategies to do that. And our financial professionals and the advisors on our platform are all delighted to discuss that with our clients and help them navigate the fortunate situation of having a large concentrated position that's run really well for the client.
Good luck with the rest of Impact. And again, congrats on this big deal for you. Your first one as CEO. I'm sure many more to come. Rick Wurster, always good to see you. We'll talk to you soon.
Thanks, Brian.
All right, just stick around. Much more ahead on Yahoo Finance.
Just to jump right in, you started this year forecasting 6 to 8% same-store sales growth. Now you're only forecasting about 3 to 4%. It seems like this year has changed a lot. What decided to do that?
Well, we've seen the macroeconomic headwinds really impact that 25 to 35-year-old guest segment, where last year, they had a lot of tailwinds, a lot of frequency. Interestingly enough, we've grown market share and wallet share with that group, but their frequency to existing restaurants has moderated as they felt cost pressures from around them, whether that's the reinitiation of student loan repayment or some of the increase in housing costs or healthcare costs or other cost pressures around them that have had them moderate their visits. And then as we've seen other impacts, whether it's tariff impacts or the government shutdown, the choppiness of the environment, we wanted to be conservative and judicious in trimming our full year outlook to account for that uncertainty.
Brett, it seems like Gen Z is all grown up now, facing these real world problems. Do you over-index to Gen Z?
We don't over-index. It is a core segment for us. And, just want to be mindful of all the challenges they're facing. I mean, when you look at the unemployment rate of Gen Z, it's double the national unemployment rate, which is why we continue to work to underprice inflation. Since 2019, we've taken less than half the price of our industry peers in aggregate. The restaurant industry has taken upwards of 34% in aggregate price since that time, and we've taken less than 17% and 10% less than CPI. So continuing to improve our relative value proposition every year, no matter whether they're facing cyclical pressures or not.
Brett, this is not necessarily a problem just for Cava. We heard from Shake Shack, we heard from Chipotle, we heard from other fast casual chains, Sweetgreen out tomorrow, that they're experiencing this pullback of younger consumers. One, how do you get them back in the door? And two, do you go to maybe those Gen X, those baby boomers who are doing really well in this economy, those high income earners as well?
Yeah, I think, Brooke, when you take a step back, our 2-year comp, our 2-year same restaurant sales actually accelerated from Q2 to Q3, from 16.5% to 20%. So we had accelerating same restaurant sales in the back half of the year. So we had more difficult comparisons. When you look at revenue on a year-over-year basis, we grew at 20%, and we grew at almost 67% on a 2-year basis. So we continue to grow market share and gain market share rapidly with all customer segments, whether Gen X like myself or Gen Z or millennials or even Gen Alpha, which is our newest generation that's starting to come to our restaurants. So we have a really diverse appeal, and it's resonating more than ever when you look at our new restaurant openings. So we noted that our new restaurants are opening at record levels north of $3 million AUV, average unit volume run rate. So we see the structural strength of our business, and just being mindful of the cyclical headwinds that consumers and some consumers are feeling more than others today, and making sure we're putting forward that value proposition to make our food more accessible.
Brett, you launched steak, you launched chicken shawarma. Will salmon be enough to get these consumers back in the door?
Yeah, very excited about salmon and how it's performed in our market tests. If it continues to progress on its current trajectory, we expect to launch it in late spring of 2026. And we've seen great acceptance and adoption. It would be our first seafood item, a fish item, which is core to the Mediterranean diet and really adds variety and diversity to our current protein mix.
Brett, you mentioned some headwinds that are still up against the consumer. Those tariffs still in the backdrop lingering. Also, that government shutdown. You guys grew up in D.C. In your front door. What does that mean for the consumer? Are they pulling back, particularly within that market? And is this something that they're really worried about right now?
Yeah, it's our hometown, and we hope this gets resolved soon for our neighbors who are not getting paychecks right now. And what we saw was that things were holding up in the market very firmly at the onset of the government shutdown. But in the last few weeks, as paychecks were not distributed, we saw some softness creep in. Nothing severe or acute, but understandably, as folks aren't receiving their paychecks, they're not out spending as vigorously as they were in prior weeks. So we're hopeful that we get resolution on this here shortly.
Tariffs still a problem too for consumers?
Well, I certainly think you're seeing price impacts all around them, whether at the grocery store. I talked about in some of our peers of the restaurant industry, which is why we've tried to absorb any tariff impact and not pass along to our guests. So we've raised less than 2% price in the last 18 months. And we noted, on our COGS line, about a 20 basis point impact this quarter from some tariff impacts that we've absorbed on behalf of our guests.
I wanted to get to something that we've all been speaking about, and that is AI. You're certainly using it in your kitchens right now. Just walk us through. Is that going to get those lines faster? And do you think that will add to maybe the value proposition that it seems like consumers are really looking for right now?
Yeah, AI holds great promise for all businesses. For Cava in particular, there's a few ways that we can leverage it and really improve productivity, improve our team member experience and our guest experience in turn. And that is really when you think about prep scheduling and cook production, forecasting and scheduling, and understanding how much food's being depleted on the line through camera vision, and then historical models on whether it's historical data, weather data, event data, sales data, and then projecting to our grill cook how much food or how much chicken to be cooking in increments, or our team how much to be prepping in the back, as well as inventory management and labor scheduling. So this technology and the data opportunities that it delivers has great promise, and we want to be thoughtful and mindful about how we incorporate into this into our business, and which is why we've been testing some of this camera vision technology, and excited at the possibilities to ultimately make it easier for our teams to run our restaurants and enhance the human experience, not replace it. Free our teams up, take some of that complexity out of their mind share so they can focus on engaging with our guests, delivering that Mediterranean hospitality and consistent food.